Andrew Hollenhorst, why do we need to raise the unemployment rate?
I think it's a very difficult situation for the Fed, a very difficult situation for the economy here. And, it may be true that a lot of what has gone on with inflation is due to issues on the supply side, but it's always supply and demand together. And I would say that's the UCLA economics, is that those two forces work together. And we have demand that is outstripping the supply side. So if you can't create more semiconductors, if you can't build more autos, the only way to bring down prices or to not have prices continue to increase is to damp demand. So it's an unfortunate outcome. It's not an outcome I think anybody is pleased that we're dealing with now.
Right.
But that is the situation, and that's standard macroeconomics. So I'm very surprised to see economists coming out and saying that there's nothing that the Fed can do. We know exactly what the Fed can do, which is to raise interest rates and damp demand.
If we get to a Hollenhorst 4% or Bloomberg Economics, Andrea Wong with a stunning essay yesterday migrating up to 5%, what does that do to the inflation rate? Does that drive us back to John Taylor's 2%? John Taylor's at a school, Andrew, north of Los Angeles. I don't know if you're aware of that, but does it get us back to a Taylor 2%, or does it get us halfway back?
I'm vaguely aware of that school. I have some family members who attended there. So, but no, what the issue here is that you get interest rates higher, you tighten financial conditions, you slow down the economy, and then you see how powerful that Phillips curve relationship is. And that's what we really don't have a good sense of. So there I would really agree with the idea that the Phillips curve does not function the way that it used to. We had a very flat Phillips curve, at least up until the pandemic period. If that Phillips curve still proves to be relatively flat, it could be hard to bring inflation back down to 2%. I'm hoping that it's a little bit steeper where we are right now, but that's really something we have to find out.
John, that's in cap. We need this as a video for this afternoon when we come back. Get one of the interns on it. Get the intern from UCLA to make the video of what he just said. John, that's the heart of the matter.
So, Andrew, let's get to the heart of the matter in this news conference. How is Chairman Powell going to navigate some of this stuff? And to Lisa's point a little bit earlier in the programme, we've been asking this question. How do you expect him to acknowledge some of the weaker data points we've already seen?
What a tough job for Chair Powell this morning or this afternoon. Tomorrow we may get Q2 GDP that we think it'll be slightly positive, but it could be negative. So we could have 2 quarters of negative growth. And then on Friday, we're going to get the employment cost index, which will probably show very strong wage pressure. So you have an inflation situation that, at least in our view, looks more persistent, looks more problematic, and you have growth that's slowing. It goes back to what we were talking about initially, and it goes back to what Chair Powell was talking about at the June FOMC, which is that it is painful to bring inflation down once you have too high inflation. I don't think that he's going to completely stick to that hawkish message from June, like you were mentioning in the market pricing. Maybe the peak hawkishness in terms of perceptions was in June. I think there does need to be, or there will be, some acknowledgement of the weaker data. That could sound a little bit dovish at this meeting, but I would look at that more as a dovish detour still on the way to a hawkish destination.
Well, let's talk about that dovish detour. Do you think that the easing of financial conditions over the last month or so will become problematic?
I think that's what the Fed is trying to figure out now. We had a very swift tightening of financial conditions. And really, it takes months, if not quarters, for these financial conditions to kind of work their way into the economy, slow down demand, and then eventually affect inflation. So the idea that you're going to see financial conditions tighten and in the next monthly inflation report see some kind of effect, I think that's really fanciful thinking. So if financial conditions have eased a little bit now, but they tightened significantly before, again, it's a reason for the Fed to maybe take a breather at this meeting and not push further in the hawkish direction. I think eventually they'll need to, but I don't know that they'll be particularly concerned that financial conditions have eased in some ways since the last meeting.
Andrew, it's so difficult for a Fed at a time when no one can predict the future and economists are very split on where things are going. So perhaps it's more instructive to understand the parameters of risk, which risks the Fed views as the most likely. Is the risk of them tightening too quickly now and having to cut rates bigger or smaller than slowly and steadily raising rates? This seems to be underpinning a big debate that the market has weighed in on, basically saying that they're going to cut rates next year and it will be net beneficial for markets.
Right. So I think that is what markets are starting to price, is that the Fed will have some kind of a pivot. And I don't think that we're going to see that pivot from this Fed. Really, we have to hear more about the Fed's reaction function, exactly how they plan to address too high inflation. If I take Chair Powell seriously, the rhetoric at the June FOMC was that inflation is the number one issue this Fed is trying to address, and that Powell is willing to do the difficult things like a former Chair Volcker did to bring inflation down. And it really is that commitment to bringing inflation down that does bring it down. If the market starts pricing, and I think it's beginning to, that this is a Fed that's not committed to bringing down inflation, that this is a Fed that's going to pivot to more dovish policy before you've brought inflation down, that's a real issue for the Fed. So they do need to get ahead of that at some point. Do they do that at this meeting? Do they wait until Jackson Hole or September meeting? I think that's where the kind of tactics come in. But in terms of the longer term strategy, there has to be that commitment to fighting inflation.
Andrew, this is hinged on the belief that seems to be the consensus right now in markets, that the bigger risk is the Fed not raising rates quickly enough and allowing inflation expectations to become unhinged. Julian Emanuel yesterday of Evercore came out and said it's actually the opposite that is the bigger risk, that if the Fed raises too quickly now and then has to cut next year, that is the key that will cause inflation expectations to become unmoored. Why do you disagree?
So I think that the risk that the Fed is facing is not hiking fast enough. If you don't hike fast enough, then you get higher inflation that becomes embedded in the economy, and it becomes that much more difficult to bring it back down. And you may need an even higher unemployment rate to bring it back down. So if you're a Fed who cares about inflation or cares about unemployment, the right thing to do is to address inflation head on. This is the lesson of the 1970s. In the 1970s, we had various scenarios where Fed officials thought that the economy had slowed down enough. They took their foot off of the gas pedal, or maybe we would say the brake in terms of the economy. And then you saw inflation pick up again and become more and more embedded in the economy. So that's exactly the scenario that I think this Fed is trying to avoid.
Andrew, just quickly, is this the final 75 basis point hike of this cycle?
I don't think so. I think we're going to see strong enough inflation between now and September for them to go 75 again in September.
Wow.
If you kind of look at where the Fed wants to get to, I think it's still significantly higher from here. So another 75 wouldn't surprise me.